You're watching the Market Comment for Wednesday, December 20th by Mario Sachikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. It's been a stellar year for stock markets. The Dow Jones and Nasdaq 100 both closed at fresh record highs yesterday, despite some pushback from Fed officials who warned that markets are getting ahead of themselves and pricing in such heavy rate cuts for next year. Investors are raising their exposure to riskier assets at a breakneck pace, as fears about a recession have melted away and a soft landing for the U.S. economy has become the dominant narrative. Speculation that the Fed will launch an easing campaign has also served as jet fuel for this rally, with markets currently pricing in 6 rate cuts in 2024. The problem is that U.S. equity valuations are historically stretched, while projections by analysts for 11% corporate earnings growth next year seem a little over-optimistic, heading into a global macro slowdown. Uncertainty around the U.S. presidential election could also act as a headwind for markets next year. All this leaves scope for disappointment in case reality does not match these rosy expectations. As such, the risk-reward profile for U.S. stocks does not appear very attractive here. In the FX complex, the British pound came under fire today, following a larger-than-expected decline in the nation's inflation rate. However, UK wage growth remains extremely hot, so markets still think the Bank of England will be among the last central banks to push the easing button. This creates a favorable setup for the pound early next year. Elsewhere, the dollar lost some ground yesterday, brushing aside some commentary from Fed officials who softly pushed back against excessive rate cut speculation. Meanwhile, the yen managed to stabilize, licking its wounds after the Bank of Japan dashed expectations for tighter monetary policy. In the commodity sphere, oil prices seem to have found some solace from the missile attacks against commercial ships in the Red Sea, which threatened to disrupt global trade routes. Alas, it's questionable whether such concerns will manage to keep oil prices supported for long against the backdrop of slowing demand next year, coupled with record-high U.S. crude production. Finally, gold prices enjoyed some upside yesterday, capitalizing on the pullback in the U.S. dollar and the persistent retreat in Treasury yields. The precious metal is on track to close the year with gains of almost 12% and close to its record highs, as investors seem to be favoring real assets heading into a regime of easier monetary policy. This was today's market comment here at XM.com.